Good day, gentlemen, and good day to those viewing this panel discussion at AfricaCom, or the Africa Tech Festival. We are talking through the mindset of an investor in the fintech landscape. And on the panel with me today, I've got two prolific investors in the South African landscape, Clive Butko from Calon Ventures and Philip from Startup Bootcamp. Gentlemen, can you just introduce yourselves before we get to the third guest, Omar?
Oh, thank you, Andile. So I'm Clive Butko. I am the ex-CEO of Accenture South Africa. I spent, following my computer science degree, I spent my entire career at Accenture. I left about 9 years ago to follow my dreams of starting and building a venture capital company. I'm the founder and CEO of Calon Venture Partners. We're a digital disruptive software tech venture capital company. We've raised quite a lot of money. We've made 8 investments, and we're looking at about 2 more by the end of the year. During my Accenture days, I actually worked in Silicon Valley, and I worked all over the world building tech companies. I've probably been involved in building about 100 tech companies, whether it's B2B, whether it's B2C, whether it's software as a service, whether they're marketplaces. So I've got the grey hair from a few of the good lessons I've learned.
And if people don't know, they should follow you on LinkedIn because you do share quite a few insights from your own experience on that entrepreneurial journey, and then the flip side being a VC. So just planting your LinkedIn channel there.
Oh, thank you. Good marketing, good PR.
Hello.
Sure. So my name is Philip Kirikoff. I'm the CEO and co-founder of Startup Bootcamp Afritech. Before coming to South Africa in 2013, I spent 20 years in New York, so I'm dating myself. Unlike Clive, I don't have any gray hair, but that's just because I've preemptively shaved it all off. But yeah, so I got my start in the mid-90s in New York, which was Silicon Alley. So it was kind of the first emerging market, and was involved both in a couple of dot-coms, but also the venture capital side. I then, in the mid-2000s, I went through kind of the boom and the bust period with some really interesting companies. And the first venture fund was Rare Medium Ventures. And then in the mid-2000s, with a buddy of mine, we raised a small US-India venture fund, which fortuitously got rolled up into a SoftBank fund that ran from 2006 to 2011, was the investment window of that fund. That was SoftBank Bodhi. And then in 2011, knowing that we were kind of ending the end of our investment period, I just randomly ended up in South Africa for the Comrades Marathon and came down to Cape Town and kind of stumbled on this very nascent tech scene, and originally planned to come and launch Horizon Ventures as an early stage venture fund in Africa. But once kind of got involved in the ecosystem, realized that really there was more need for accelerator and incubators and helping startups to prep themselves to become more fundable. So that's, then I met Zach George in 2015. We launched the first African-based accelerator, corporate-backed accelerator program. And we've been running accelerators ever since. Startup Bootcamp was launched in 2017. We've done 3 cohorts now, accelerated 30 startups, and we take investment positions in those. So I'm involved as an investor in about 45 African startups.
Thanks, Philip. And one of those startups would be Omar Base. I'm not sure if I'm pronouncing your surname correctly, Omar.
Yeah, exactly.
So please give us an intro on yourself, the business, and just what you guys do.
Oh, well, thank you so much. My name is Omar Bas. I'm the co-founder and the CEO of Yobante Express. Actually, Yobante Express is an online marketplace. We do connect local couriers with local commerce, solve the biggest problems of emerging markets. We're talking here about domestic, cross-border, or last-mile delivery in Africa. Basically, what Yobante is like doing is we specialize in making affordable to send parcels, leveraging on gig economy, a cutting-edge technology that using machine learning to deliver from point to point until the last mile delivery. Actually, we deliver 40% cheaper and twice as fast and most important, more efficiently than existing solutions from point to point into the last mile delivery. Now we went from one country, our home market, Senegal, to 6 other countries where we do operate. And we're delivering, on average, more than 20,000 parcels in a month. And we're making, more than $120,000 in a month. And now we actually leveraging on what we get, like a network of more than 600 relay points globally in Africa. We operate in South Africa, where we deliver to Gaborone and to Harare, which is actually in Zimbabwe. And we do operate in Nigeria as well and in Ghana.
Thanks. Sounds like it's growing fairly rapidly, and that's the kind of startup that investors like Clive and Philip like to see. So before we get into the detail of how they evaluate their startups, there are a few general questions people always have around the funding space. And the first one is whether all startups actually need to get funding. So should all startups be targeting venture capital funding? And that one I'm going to pose to you, Clive.
I think that's a great question, because I must say it's the first question I normally ask entrepreneurs: do you actually need funding? Because the immediate answer is, I need funding. I say, why? Because everyone else is raising funding, opposed to, because I need the funding to actually scale my business. So that's a great question to ask, and the answer is no. Every business does not need startup funding, and particularly startup funding. They might need venture capital funding, maybe for a Series A, Series B, Series C, for real scale, geographic growth, new product launches, going all over the world. You might want to raise venture capital because you can scale your business much faster than growing it organically just with out of cash flow. So it really is, one thing, raising venture capital is very dilutive. So it's going to dilute your equity. It is definitely going to be, a VC like myself, I'm going to have negative provisions, so some sort of control over what you can and can't do with your business. So I think every entrepreneur really needs to ask themselves a question: can I find a way of bootstrapping my business and rather get customers to fund my business going forward? So a tech business, which is typically a capital light business and not capital intensive, like like building Elon Musk a car. So it's a capital light business. You can do it out of families and friends, and sometimes they say fools as well. You can fund it out of that, but the best funding to get is customer funding. So if you've got a real vision and for your product, go and sell it to the customers, sell them what problem it's going to solve, and very possibly your customers will actually, like crowdfunding, your customers will actually fund your development, and that is non-dilutive capital. So no, you do not need funding day one. And my advice to anyone, even though I am a venture capitalist, is don't go and raise venture capital too early. They'll take too much of your business away, and you're going to lose control of your business.
Thanks for that. And one of the other additional factors is people, or entrepreneurs in this context, tend to forget that when you're raising from a VC is also expecting certain returns. So it's not money for just you to go and try out your new idea. There's a certain requirement, and you're now accountable on top of having diluted, right? And so for that piece, Philip, I'd like to get your thoughts on how an entrepreneur can evaluate to themselves whether their business is actually fundable from a VC pool of funds, or should they be looking elsewhere, to the kind of avenues Clive had alluded to.
Absolutely. Yeah, I would totally echo what Clive is sharing. The longer you can go as a startup without getting VC funding, the better off you are. And I would even extend that to angel funding. What you're looking to do is, as Clive mentioned, is to really validate your business by building a business. And so the more funding you have from your clients in the form of revenue, the more runway you have as a company, but also you're increasing the value of the business, which means that you have better leverage in negotiating terms with the investor. You mentioned different types of investors. So typically, if you can get the initial angel investors, you basically at each stage you're looking for maybe 6 to 9 months maximum of runway. So in the early stages, that 6 to 9 months is going to come from angel investors. or accelerator programs like ourselves. And then, as you move forward, then you can look at more towards traditional venture funding. There's also impact investing funds that are out there, which might be, they might have more favorable terms, but they also may not be able to bring the same types of relationships. And or their provisions might require certain other metrics. Now, the one thing I'll say is that, when we are looking at African businesses, nearly every African business qualifies as an impact business. If you're in the fintech space, typically that's going to be an impact business for most impact investors. Ag tech, there's insurtech. All of these are basically expanding the pool of access for consumers. So it's really just a matter of positioning. And then the final thing is, and this is probably a segue in for Umar, who's, just in terms of full disclosure, was one of our portfolio companies, is, that a lot of times you don't fully understand how your business might fit into other categories. So when we first met Umar, he was in a logistics business, but we were able to help show them how Yabante was actually providing another critical value proposition. And so that was able to expand the types of investors that they would potentially go out to.
Thanks. There's actually a follow-up question coming on later from my list of things I'd like to pick your brains for, and that does speak to it, the breadth of what else startups could be playing into, especially when you look at fintech. Now, bridging from the fact that we've discussed there is funding, but for entrepreneurs, you don't always need to get VC funding. Let's assume you've gone through the process, you validated that, VC funding, I'm ready for it, and I can generate the kind of returns that they require. One of the other hurdles when you look at the African landscape and speak to entrepreneurs, the perspective there is there's a lot of money spoken of being channeled into the African tech ecosystem. Fintech alone has been in the, 725 million rand, or dollars rather, in 2018, 900 in 2019. This year, we're already close to about 660 in terms of funds just for fintech. So the capital is out there, but their sense is that's going more towards growth stage businesses, and there isn't enough in the early stage, so seed and some of the angel investors. I want to just get your thoughts as to whether that perception is correct, and what other comments do you have to add on that? Philip.
Look, I think it's the very nature of venture investors, and especially a lot of that money is actually coming from overseas. Investors are inherently risk averse. People often don't appreciate the fact that no investor wants to lose their money, and so if they can invest into later stage companies with more traction, it's a lot easier for them to wrap their head around how to do a risk profile on that investment. So yeah, sure, we can complain a lot about the fact that the vast majority of the money, or a significant percentage of the money, is going to the later stage, but it really isn't the job of venture investors to be doing early stage investing. That's inherently going to come from angel investors, and it's the job of the founders to go out and find those networks. So there's some awesome networks that are really gaining traction. The African Business Angel Network, and then Saban, in South Africa, and Josie Angels, even more like, locally in like a specific city. But in Dakar and Senegal, there's, programs from the government like DARE. So there's a ton of different initiatives across the continent that are happening where there is funding available for those earlier stage businesses. And the startups that are able to successfully really present their value proposition and the problem that they're solving are being able to close on those rounds. And certainly you can talk about kind of investment structures that make sense for both the founders and the investors, but it really is not an issue of not enough capital out there. It's just a matter of successfully positioning your business proposition and the problem that you're solving in a way that makes sense to those investors.
And then getting into the right networks. Yeah, go ahead, Clive.
No, I was just going to add to that. So just in my experience of being in this venture space for a long time, great business will get funding. a great business that's doing basically the velocity, which is really double-digit, 10, 20, 30% month-on-month growth, will get funding. So if you can get to, typically, it's like a software as a service business, typically, if you can get to $1 million annual run rate, so 16, 17 million rand of ARR, you will go and without a problem raise $5 million in a Series A or Series B. So if you can get to that stage, get to $1 million, maybe as Philip was saying, through the angel funding or through the networks, whatever your networks are, you will find that money will find you. You won't have to worry about that. But it is easier. I'm right now looking at raising big amounts of capital, Series A, Series B, in a couple of my companies. And there's no question where we're domiciling overseas, in Delaware, specifically in the US, there's a lot more capital that will chase the opportunity now that it's actually a Delaware-based company than it's an African-based company. There are funds, particularly European funds, that do invest in Africa, and that's really around your Series B, Series C, your $5 million, $10 million checks. But if you can re-domicile your entity and not be South African entity anymore, there's going to be a lot more capital, a lot more choices to actually raise large amounts of capital at very attractive valuations relative to the valuations you'll get in South Africa and Africa as well.
On that point, before I get Omar to give us some of his experience, because I spoke on his behalf as an entrepreneur, the point you made around the foreign funders who are also injecting capital, when you look at most of the capital that's circulating in the African landscape, it has come from foreign pools. So is it a case of Africa not having built up the depth just yet because our tech ecosystem is very nascent and so the guys would understand it, so still building their net worth in order to be able to plow back? Or is it that African investors are a lot more risk averse than our counterparts on the global context?
Yeah, it's quite interesting. I spent quite a bit of time in Silicon Valley. And I remember in the old days, the guys were saying, unless you're within a 20-mile radius of where I live, I won't invest. And that was their philosophy. If I couldn't drive to a board meeting, I'm not investing in you. I think COVID has fundamentally, I've been in contact with a lot of my mates, colleagues and mates all over the world, and COVID has completely changed that. Now they don't get relocated because, in all honesty, people that you had to hire in Silicon Valley, you had to have your offices in Silicon Valley, were only investing in Silicon Valley. Now all of a sudden you can hire from the whole of America or anywhere around the world at a fraction of the price of America. So COVID, I think, has been, from that point of view, has been very positive. That all of a sudden the world is your oyster. You can actually attract capital from the globe, and you can attract human capital from the whole globe. And it's not about within the 20-kilometer radius or mile radius of Silicon Valley. So I think, there is a lot less capital, as you rightfully said. There is not a fortune of capital in Africa. Africa's got 13, 14% of the global population, and I think 1% of the venture capital relative just to the US that's been spent in African startups. So you can get the perspective of how small and how nascent we are as a venture capital community in Africa.
Cool. There's a couple of things I still want to come back to, especially with the COVID learnings, because there are some insights there for entrepreneurs, guys who are building out, and some of those who've already scaled. But before we get to that, Umar, your experience raising capital, how has that been? And is it as tough as a lot of other guys have spoken of when they look to raise their seed stage?
Well, first of all, I will say that I completely agree what have been said. It's all about positioning your business and getting the good type of angels, and that you can get it from accelerator program or government fund. For your Ubuntu Express, for instance, actually, we have successfully completed our $500,000 seed round, actually from angel investors. And we're currently adding a $300,000 safe round, pretty much the same one. But we did also get found from actually that support and that network we're getting from accelerators such as Bootcamp, and as well as we get foundings from the Senegalese government program there. But the most interesting thing is to position your business, because the important things to say about your Ubuntu Express, one of the most important things is what we're doing actually is solving logistics challenges that many industry verticals face. For instance, e-commerce businesses, B2B supply chains, national utility inefficiencies, and so on. And that creates and shares values across the entire ecosystems, especially corporate, small businesses, and gig economy workers. Well, to be back about our seed round, I will say it's all depending on how you position your business, right? And keeping in mind that getting angel money is not easy, but you could achieve that if you have like the right stuff. I mean, you have good execution, and actually you have a great product, and of course you have the good type of angel network. But from another hand, getting VC money is like a little bit more tough than people expected, because we could say that getting VC capital in Africa is a tough and long process, because from my own experience, I could tell. However, there are a lot of improvements that we have seen over the past few years, especially with Geobonte, because with that $300,000 round, we're in discussion with 2 VC firms that are interested to join, not only to join at this early stage, but for our next rounds. What we could say is like that investors' gain of interest is because of economic and commercial opportunities that we're seeing in Africa. And in addition, with that COVID-19 crisis escalating, stay-at-home orders have led to a surge in online purchases in Africa. That is clearly a favorable environment for investment in the logistics sectors that we operate as Geobonte Express.
And one of the things that I actually like about how you also answered the piece about the seed funding, which links to how Philip had mentioned, it's about positioning your business properly. When you're an entrepreneur in Senegal and you're looking at the funding in Africa, it tends to go to the hotspots of Nigeria, Kenya, South Africa, and Egypt. So being somebody starting a business in Senegal, but making sure that the problem you're solving is universally applicable, make sure that funders beyond just your immediate environment can also see the potential and therefore want to take it up. Is that your experience? I'm making my comment, but I suspect that that's how it came through for you.
Yeah, exactly. You know, it's a very important thing to get a working business in your home market. But if you have small markets like we do in Senegal, of course, it's great to be the number one in Senegal. That's what we are now. And doing logistics in Senegal taught you a lot. But actually, the problem is an African problem. Because if you see, to say that numbers are talking, right? If you take, for instance, in Senegal, the formal delivery network is actually 7.2 million parcels a year. But the informal network is like estimated to exceed 25 million of parcels per year. And if you take, for instance, the rest of Africa, actually there is a huge market out there. No one knows how big it is. Actually, you take South Africa, of course, you have great logistic companies, but a lot of people are using those informal bus networks to send their parcels to cities like, to states like Eastern Cape, or beyond that, even to the capital cities as well, from Cape Town or from different states to other. And this is how we was able to get, of course, the right product working in Senegal, but being able to prove that our model is scalable and we could like replicate the same model in different other African markets that are far bigger than our own markets. And actually, what we did with the support of Startup Bootcamp, and of course, our team was pretty much implicated into that process. And it's absolutely something that will make the balance in the final VC or the angel decision to invest on your company. Because we do have small markets, and if you're not able to show that you sell it locally and you're able to, to scale, it will be much difficult for you to get money out there.
Yeah.
Yeah, and if I hop in for 1 second, what he's highlighting that's so critical is this concept of validation, and we talk about it over and over and over again. If you go to an investor and you say, hey, we're doing this in one country, we could do it in many other countries. That's a pitch, right? And what Omar and Yabante were able to do is say, cool, we're going to validate, we're going to demonstrate that we can do it in multiple countries. So even though the number of transactions in these other countries is relatively small compared to Senegal and their home market, the fact that they've now proven that they can do transactions in 5 different African countries opens them up to an entirely different category of investors, right?
Yeah.
So the revenue can be relatively small, the number of transactions can be relatively small, but the fact that they're actually doing it versus theoretically could do it is chalk and cheese. It's 2 entirely different conversations. And that's,
thanks for making that.
And that's the movement between an angel investor that's willing to take a big bet versus a VC investor that wants to see proof, right? So Yabante is now in the category of having proven that they can move and operate in multiple markets, multiple parts of the continent, in different languages, different currencies. They've basically they've de-risked the investment significantly, and now they're in scale mode, and that's the kind of investment that a Series A investor wants to come in on.
Which is where Clive, sitting back, just listening in, might be having his ears prick up a little to sense whether there's an opportunity. And the reason that for me is something critical, because there are certain yardsticks that you've mentioned, which when you look at the Kalon website for the criteria for your investments, there are a couple of things that have been mentioned here that you guys specifically want to see. So I'll pick out just a few: strong team, traction with referenceable client base, and a scalable business. We've just been talking about scalable business. And what I wanted to unpack a bit more with you, Clive, is in the fintech kind of landscape, what rate of growth is sufficient for somebody to then know that they've got a scalable business? I'll unpack each of the others in turn as well.
Yeah, I don't think, Ndili, that it's a fintech issue. It's a venture capital backed company issue about traction and about scale. If you want to blitz scale, the lovely book I'm sure many of you have read about from Reid Hoffman about blitz scaling your business, you want to make sure if you put in, for us, if we put in $1 million, I want to make sure I can get $10 million back in 5 to 10 years. That's an absolute minimum. I'd like to get $100 million or more than that. But if I can't see a 10x return on my capital, then I'm not going to make that investment. So that's how I differentiate between what I believe is a venture capital backed business to what might be a very good business. Because a very good business does not equal a venture capital investable business. And a lot of people don't understand that. They just say, wow, I said, because you've got a great business, but it's not something I'm going to see 10x on my capital. It's not something that's going to be scaled all over the world, where your revenues can scale a lot faster than your costs, or you can keep your costs pretty static, but your revenue can go 5, 10, 20 times larger with the same amount of capital. So that's what, I would say typically, if we're not seeing double-digit growth before a business is $1, $2, $3 million, $4 million, $5 million, we're not seeing at least 10% month-on-month growth, which is about 200% year-on-year growth. It's not a venture, for us, it's not a venture capital investable business. It's not, the validation that, Philip spoke about is not there. If you really are, if the dogs are eating the dog food and you really are solving a customer pain or satisfying a need or doing the job that they need to do, you will go at that pace. And if you can't, it's either the problem is your product or the problem is execution. One of the two. And most products most companies don't fail from lack of product development. They fail from lack of market development. So you haven't developed your market fast enough. You haven't articulated the problem that you're solving to the market, that they're buying as fast as they need to buy, that you can grow 10, 20%, 30% month on month. So if I look at most of our companies, honestly, we're achieving a minimum 10% month on month growth. Unfortunately, in COVID, which I know we're going to come back to that, but one of our businesses grew 300-400% during COVID. Others grew 100%, 200% during COVID. So COVID was completely a COVID beneficiary of our businesses, opposed to one of our businesses, which I must say was hit really, really hard by COVID. So we had one a casualty, but others have been COVID beneficiaries. So it was luck of the draw. It wasn't our insights or foresights that did that. They were all growing double-digit month on month, but COVID stopped the spend in that sector. So yeah, double-digit month on month must be a reasonably good base. Double-digit month of $50,000. It doesn't prove to me that you've got a repeatable and scalable sales model and a business model. But offer $100,000, $200,000, $300,000 per month, you've pretty much proven that you've got I can put $1 million on, and that million will turn into 2 million, 5 million, or 10 million. I don't want to put $1 million in and it turns into 500,000. That's not a good investment.
One of the things I've seen you specifically focus on when you reference scalability is also profit, not just revenue, because you've indicated how you see revenue as a vanity metric, not to discount it, but you want to see that it filters through, because if it's scalable, then your operational efficiency should be giving you greater profits, correct?
Yeah, look, yeah, the last thing we focus on is profitability. We want to see the path to profitability. So absolutely, it's very important that the business can be profitable. You know, there are businesses listed on the New York Stock Exchange or the Dow that someone like called Uber that have said they'll never become profitable because their business model doesn't enable them to become profitable because they keep on buying customers and buying drivers that it's very hard to become profitable. So we don't want to become profitable. We measure ourselves on revenue growth because remembering the next time we want to go in the tech space, you actually value a tech business, a scalable tech business on a multiple of revenue, not a multiple of EBITDA or anything like that. That's more private equity. So we want to know, sure, there's a path to profitability, but we want to pour fuel on the fire, and we want to scale that business. So any additional cash we've got or any additional investment, we want to drive the top line growth, but knowing that we can get to bottom line growth if we need to. So we could put more money into marketing and sales. We can take the 1 million, make it 5 million, because when you can do that, you know as a VC, you've got a repeatable and scalable sales model. So I know I put in $1 million, I'm going to get $10 million out. I'm not worried about profitability, but if I want to turn back the marketing dial, I can get my profitability if I want to. But that's not the business we in as a VC, particularly at the pre-Series A, Series A. We still want to go for very, very hard revenue growth and keep on driving that double-digit growth. And that's just going to put up the valuation significantly and enable us to raise capital at a significantly large amount of capital that we can really start scaling our business across the globe.
Yeah, and I would just add to that, I mean, the key thing I think that we try to really focus these startups on is ensuring that the unit economics make sense, right? Yeah. We understand that, you know, especially in B2C business, in many startups, but especially in B2C, you know, those, you know, there's an initial customer acquisition process. And those unit economics are going to be tough. But if you don't see a pathway to getting those unit economics right, then you need to pivot your business model. So a lot of the startups that we work with in the accelerator start out as B2C businesses, and then we help them see how they can be a B2B or a B2B2C, and how they can, you know, or white label their products, or, you know, there's a whole slew of different pivots that they can focus on that don't relate to changing the product, but can have fundamental differences in the fundability of the business because they've changed their business model or their pricing model, and they've made it more attractive to potential investors.
Just to add to that, I just want to add to what Philip's saying, because he's saying something so important that I think all the entrepreneurs out there, if you're building a B2C business, just be aware it's a very, very capital intensive process, because that cost of acquisition, you have to, for one, make sure that your churn rates are very, very low. So you shouldn't, if you're hitting more than 6% churn per annum, and I'm talking about revenue churn and logo churn, you should not be hitting more than 6% per annum. That is less than 0.5% per month. I've seen some businesses that are hitting 30% month-on-month churn. Now, obviously, I don't touch them because what that is like a Ponzi scheme. You just have to keep on putting more and more money at the top into marketing, and you get more and more customers. If you stop putting the money at the top, the customers just dry up. So you have to make sure those unit economics, as Philip was saying, and particularly the cost of acquisition and the lifetime value, that the economics make sense.
You know, we really helped encourage them to look at their business from first of all, their unit economics were really solid. But what they needed in order to scale was to get to many more customers as fast as possible. And so we said, look, you're competing currently with the mainstream delivery businesses and logistics companies in your country. Why don't you go to them and say, look, you can actually deliver cheaper than they can deliver themselves, so you could be the back end operation for their delivery. And sure enough, they went with that proposition, and those companies were more than happy to be the face of the delivery, but meanwhile, effectively hand off a significant percentage of their deliveries to Ubante's infrastructure, and now they're servicing some of their biggest competitors in the marketplace. They're actually the back-end delivery for them.
Cool. We almost have, we have about 4 minutes left, so I'm going to rush through two things. The one does speak to how you'd help Ubante see a different avenue as well and how they can expand their business. Because even in the fintech space, there has been a growth in the opportunities that are not themselves pure financial services products or services, they're offering something else, which gives you a captive audience from which you can then offer those financial services. Philip, are you seeing that as a trend that's going to grow in this particular space for fintech kind of investors, or is it something that's flash in the pan, one or two will get to do it?
Sure. I want to make sure that Omar is able to tell this part of the story. So, Omar, is your microphone back on?
Oh, can you hear me?
Yes, we can. I think it's really great to highlight how you picked up as an insurtech business, how you turned a logistics business into an insurtech business.
Well, actually, the story started with actually we was working with a insurance company in Senegal, Wafa Insurance and then AXA Insurance. But what we do notice was out of after our first year, out of 96,000 parcels we delivered, only 3 parcels was lost. And then we would say, hey, look, we're delivering this number of parcels, and we only lost few of them. Why using? I mean, and we knew that the average parcels that we were delivering for e-commerce, clients, for our retailers, clients, or for even for our businesses, is like evaluated. For certain of them, up to $100. And we were saying, hey, look, we can afford ourselves to refund, a part of parcels that we are losing actually, because it's pretty much very low. And we did say, oh, look, we will automatically insure all parcels up to $10. And between $10 to $100, we will add up to $1.50 for insurance fee out of the delivery fees that we are charging. And we did that at the beginning of this year. And now our loss rate is like, very low. It's like 0.01%. And we making now money not only from deliveries, but also from that insurance part. And now we're about to extend that for parcels that are high valued, like for parcels up, beyond $100. And that's what we're about to do. And we clearly have an insurance product included into our, logistic service that we are providing to our clients. And that's how we went from a single revenue model to a multiple stream revenue model.
Yeah. So what's cool about it? What's cool about it is just doing the math. We were able to look at it and say on a spreadsheet, this is it's not going to cost you anything. You're once out of every 30,000 products, you might have to do a single payout. So you can get free revenue, offer a real value to your customers by saying, hey, if we're going to offer you a low insurance premium, on a per package basis. From the customer's perspective, a $1 insurance on a $100 product makes a lot of sense. But all of that is basically just free revenue and nearly 100% profit for Yvonte, right? So it's just looking at your business and seeing how you can bolt other things onto it that helps the business, but also, again, comes back to this idea that it makes the company more investable, because investors like the way that they're thinking about it, right? They like that cleverness, they like that insight, and of course, every investor likes to see, almost a very, very high margin profit on something that's so simple.
Yeah, like delivering value on so many sides. We're pretty much out of time. So the last parting shots that I'd like to get from both Clive and Philip with regards to COVID, and then Umar as well, is from Clive. For you as an investor, what are the 2 lessons that have come through from COVID? Has it changed in terms of making you more risk averse, or do you see greater opportunity than there was lost in this period? So just your 2 notes there. And then Philip, from your way of evaluating entrepreneurs, has it impacted the way that you view entrepreneurs? So just 2 quick pointers on those 2 fronts. Umar, I'll ask your question just now.
I think, just on the COVID side. So I think number one is from what we did. First thing we did when COVID happened is we triaged our businesses. So we looked at which businesses make sense, which businesses don't make sense, and how we can pivot. So probably the most important thing is look at every single expense line and make sure that you're absolutely frugal. If you're frugal in bad times, you'll be frugal in good times. So you have to make sure you check every line item on the income statement and cut. So the first thing we did, we wanted to make sure we had 24 months of runway. Because we had 24 months of runway, we didn't know how long this thing was going to last, and we still don't. But all our businesses fundamentally changed their cost line and cost structure. If they couldn't impact their revenue line, that we lasted 24 months. So that's probably the most important thing. The second thing we did is we looked at each of our customers and say, are they A type of customers or green, that they really are COVID beneficiary type of customers and they're going to want to keep on spending and innovating? Are they sort of neutral by COVID, or they've been hit hard by COVID? And the ones that were in the B and C, either were neutral or hit hard by COVID, we stopped focusing on those customers. We focused on those A-type customers, the ones that were COVID beneficiaries, the ones that were going to be looking at innovation, looking at new solutions, looking at disruptive technology. And honestly, from that, those businesses that have done that well, our businesses, as I was saying earlier, have grown incredibly well. So, COVID was an incredible opportunity.
I don't think we're going to have time, Philip and Umar, looking at the clock. So thank you so much for each of you having afforded the time to this panel discussion. And I hope that all of the audience members got some really good insights. And if you have questions, there's always a channel for you to ask. Reach out to each of the investors on their social media platforms. I don't know for you, Umar, if you wanted to be reaching out on your social media platforms as well, but
definitely, I will be happy to as well.
Okay.
Especially if you're an investor looking to invest.
Exactly.
Keep well.
Okay.
Thanks, Adile.
Thanks, Adile.
Cheers, guys. Thanks, Adile.
Thank you so much. Bye.